Investing in the stock market offers a multitude of opportunities for investors to build wealth and to achieve their financial goals. Now, the two prominent investment strategies are either focusing on high-yielding stocks and ETFs, or focusing and investing into lower-yielding but higher growth-oriented stocks. Now, high-yield stocks and ETFs can provide attractive income potential, while lower-yield and higher growth stocks offer the allure of larger capital appreciation down the road. And during the early stages of anyone's dividend investing journey, the options can feel daunting, and this was exactly the challenge for me early on. Now, I've been dividend growth investing for around 7 years and currently own a 7-figure investment portfolio. It's safe to say that I've learned a lot throughout my journey, and I definitely hope to help you skip over some of the easy mistakes and point you into the direction that you are destined to go to. So in this video, we are going to do a deep dive into some of the pros and cons of investing into either higher yielding but lower growth potential stocks and ETFs, and on the other side, lower yielding higher growth stocks and ETFs, and try and figure out which investment strategy is the best option for dividend investors. We're going to go over all this and more. All I ask, if you could please drop a like in this video and subscribe for more videos like this in the future. This right here is a perfect example of a higher yielding stock, Main Street Capital, ticker symbol MAIN. Now, Main Street Capital offers a starting dividend yield of 6.9%. Now, in my opinion, anything over 4 or 5%, whether it's a stock or an ETF, would probably profile that asset as a higher yielding stock or ETF. So Main Street Capital, in my opinion, is a good example of a stock that offers a high starting yield and does offer some capital appreciation, but not necessarily the same capital appreciation that you would get by buying into a high quality, lower yielding, but higher growth potential stock. Now, another example of something that has a higher starting yield but lower growth potential is something like the JP Morgan Equity Premium Income ETF, known as JEPI. Now, JEPI, as far as all time, is only up 5.11%. But the thing is JEPI has a trailing 12-month dividend yield of 11.39%, which definitely classifies JEPI as being very high yield. So now that we went over an example of a higher yielding stock and a higher yielding ETF that both offer a very high starting dividend yield, but haven't really had all that much capital appreciation in the past, let's talk about some of the pros of investing into something like that. So of course, by investing into higher yielding, lower growth potential stocks or ETFs, you're going to have the potential for higher income generation. Now, high yielding stocks or ETFs can offer a consistent income stream. Investors seeking regular cash flow for living expenses or to reinvest can benefit from the steady dividend payments provided by high yielding stocks or ETFs. Also, these names can offer stability and defensive qualities. High yielding stocks and ETFs are often associated with established companies that generate stable cash flows. Now again, this is just most of the time. These companies tend to operate in mature industries, providing a level of stability throughout the market, no matter what downturns or uncertain economic times are ahead. High-yielding stocks and ETFs can be very defensive during times of volatility. Now also, when it comes to higher-yielding, lower growth potential assets, the dividend reinvestment and compounding effect can take place much quicker. And this is because reinvesting dividends from high-yield stocks can amplify returns by reinvesting dividends to purchase additional shares. Investors can increase their holdings and potentially accelerate long-term wealth accumulation. So in theory, if you are paid out more in dividends than you would be by investing into lower yielding assets, you in theory would have more money to buy into more shares of whatever you'd like to. This can make the power of compounding take place much quicker. Now let's talk about some of the cons of investing into higher yielding stocks and ETFs. So limited growth potential, that's the obvious one. High yield stocks and ETFs typically have slower growth prospects compared to growth stocks. Companies that prioritize dividend payments may allocate a significant portion of their earnings to distributions rather than reinvesting in expansion, innovation, and growth. Also, higher yielding stocks and ETFs are still vulnerable to certain economic and industry changes. And in certain situations, you can even see that nice juicy high yield be cut. I've personally owned multiple different stocks in the past that were offering a massive starting yield, and once things turned sour for the company, the dividend was cut very quickly. Before we go over some of the pros and cons of higher growth, lower yielding dividend stocks, let's go over a few examples. Now, Apple stock is a perfect example of a stock that does pay a dividend. It's a lower starting dividend yield, but the growth potential for Apple has been astounding. Apple's starting dividend yield is 0.56%, so investors are not going to get rich by any means off the dividend when it comes to Apple. but with the possibility of massive growth potential. If an investor were to have bought Apple a while back, they would most likely be up so much in their position, much more than most any high-yielding dividend stock or ETF across the board. Now, a great example of a lower yielding but higher growth potential ETF, in my opinion, would be DGRO. Now, DGRO hasn't been around all that long, but it's up over 95% on the max chart. DGRO offers a 2.43% starting dividend yield or something around there. Now, this isn't the biggest starting dividend yield in the world, but DGRO has a history of growing their dividend at a very fast growth rate, which means investors that buy into DGRO will likely get paid more and more and more over time. Not to mention the price of the ETF will likely go up along with the market over the long term. So some pros of investing into something like that would be, of course, the capital appreciation. By investors buying into lower yielding growth stocks and ETFs, they have the potential to benefit from a significant capital appreciation over the long term. These assets are often associated with names of disruptive industries and emerging markets and technologies, offering massive growth potential. Now, allocating a portion of the portfolio into lower yielding growth names can enhance the overall portfolio growth. The compounding effect of high growth rates can accelerate wealth accumulation and can definitely in some cases do much better than a portfolio of high yielding assets. Now, there still are some cons of investing into the lower yielding higher growth names, and this is of course volatility and risk. The potential for significant price swings can be more apparent when you're investing into higher volatility or higher beta names. Also, when you're investing into names that have higher growth potential, there's an inherent risk involving speculation about future growth prospects. You're sort of betting that the assets are going to grow over time, when in theory there could be 10 years of a growth stock or ETF trading sideways. The last con of investing into lower yielding higher growth stocks is of course the lack of dividend income. And that's because these companies often prioritize reinvesting their earnings. So investors that are focused on regular income and more interested in larger dividends, these higher growth names will likely be much less appealing. So there's some of the pros and cons of investing into higher growth versus higher yielding dividend stocks and ETFs. Of course, determining which strategy is going to be better for you depends on various factors like the individual investor's goals and strategies. Things like your risk tolerance and time horizon. For me personally, it always comes back to diversification. Having some higher yield, some lower yield, some higher growth, some lower growth. But I want to hear from you guys down below. Comment down below if you're more interested in higher growth or higher yielding assets. If you enjoyed this video, make sure to please drop a like in the video and subscribe for more. Thanks as always, guys, and I'll see you in the next one.